Good afternoon. I'm Brownfield Livestock Market Reporter Megan Grebner. With us this afternoon is Michael Langemeier with the Center for Commercial Agriculture at Purdue University. Good afternoon, Michael.
Good afternoon.
Today we're going to talk a little bit about cattle finishing net returns for 2020. So as we get things started with our conversation, what are some things that we need to know and to think about as we're looking at the bottom line for cattle?
This has certainly been a roller coaster year. I mean, cattle finishing has a lot of variability, but this has been a year with immense variability. With the packing plant closures in the summer, not at capacity for quite a few months during the summer, and so returns have really changed dramatically from one month to the next. And so what I'm trying to do with this current study or update is to take a look at trends in feeding cost to gain, feeder to fed cattle ratio, and net returns, and kind of look at the history, where we've been in 2020 so far, but also look at net return prospects for the next few months.
Michael, as we talk about this, really, I think we have to look at the input price aspect of it, because up until recently, it was really beneficial for not just cattle producers, but all livestock producers in general.
Yeah, and when you're looking at cattle finishing net returns, the two big factors by far and away that drive profitability is feeding cost to gain, and the second one is the feeder to fed cattle ratio, and I'll discuss those in turn. The first one, feeding cost of gain, is driven largely off of corn prices, but there's also performance, animal performance, feed conversion, average daily gain impacts feeding cost of gain, as well as forage prices. Whether you're using DDGs or alfalfa, they certainly also have an impact on feeding cost of gain. But probably the big factor there is corn prices, and corn prices, just like cattle finishing net returns and fed cattle prices, have been on a roller coaster. We started the year with fairly strong corn prices, at least as far as this last few months has gone. And then we went all the way down to 310, a projected price of 310 from USDA. And now we're back up to a projected price for next year of 360. And so we went down 50, 60 cents, and now we're up about 50 cents. And so that certainly has a big impact on feeding cost of gain. When I was looking at feeding cost of gain earlier this summer, it looked like we could have feeding cost of gain in the low 70s. That certainly looked possible. Now, when you start looking at where corn prices are today and where they're likely to stay the next few months, we're looking at something that's closer to $80 to $81 per hundredweight, which is really quite similar to where we've been the last few months. And so steady feeding cost of gain rather than falling feeding cost of gain.
When producers take in this information, what are some nuggets maybe that they need to grasp on as they're trying to maybe manage some risk and figure out the best way for them to proceed?
Well, one of the keys to success, and this is easier said than done, that's where that's where thinking about some price risk strategies is very important, is feeding cost gain has an impact on net returns, but what has a larger impact on net returns is what I call the feeder to fed cattle price ratio. If that ratio gets too large, meaning we've paid a lot for feeder animals compared to the fed cattle price, returns drop dramatically, and vice versa. If for some reason we pay a certain price for a feeder and fed cattle prices strengthen, that feeder to fed cattle price declines, and we make relatively large profits. And so that's critical. When you're placing cattle on feed, make sure you buy them right. Make sure you create a budget so it looks like it's going to work, at least on paper, when you start, and then think about what you can do in the fed cattle price to try to reduce risk on the fed cattle price, because when fed cattle price moves around a lot, is quite variable. That's when you really see some big swings in net returns.
In your latest Farm Doc article, you do reference and have some graphs that folks can see. What are some things as they're looking at those prices and those graphs that they need to be?
The long run average, and this is using a 10-year average of that feeder to fed cattle price ratio, is 1.22. So that means that feeder prices are 22% more than fed cattle prices. And so when you're creating your budget, if it looks like if it looks like your price ratio is quite a bit larger than that, don't feed the animals, because it doesn't take too large a swing in that ratio, and you're looking at red ink. Vice versa, a good time to buy cattle is when that ratio is below 1.22, and we do go through periods where that ratio is considerably lower than 1.22, and so I use that as a gauge of when to place cattle and when not to place cattle, but also a way to think about risk as those cattle are in the feedlot. If it looks like that, you're always dealing with fed cattle projections, but if it looks like that feeder to fed cattle price ratio is increasing, is there anything I can do to try to protect myself against further drops in that fed cattle price? And the reason why I say this is so challenging is we know what the feeder price is when we place the cattle, but we have no idea what that fed cattle price is going to be. We have projections, but quite often the projections at the start of the finishing period are quite different from what they are even midway. Through that feeding those cattle, because usually the cattle are on feed 150 to 180 days, and that's a long period of time. And fed cattle prices can really move around during that period when you place the cattle to the time you sold the cattle.
How much has the whole disruption from COVID played into what we're seeing when it comes to break-evens, net returns, profitability for producers?
It had the COVID probably had a very large impact primarily in April. Let me check here. April, May, June, and July. And so when you look at those 4 months, the largest losses occurred in April and July. And in particular, I think probably the largest impact was June and July. The cattle coming out in June and July. That was the same time where we were having some capacity issues in the packing plants, and losses were in excess of $200 a head during those particular months. And we have losses of $200 per head periodically in the cattle finishing industry. It's very, very risky business. But we were looking at much smaller losses pre-COVID to $200 per head. And so really what COVID did is it created some really large losses for the summer, and it's still playing out. We had some heavier cattle, because of the capacity issues in the packing plants. We had some heavier cattle coming to the packing plant, and so the industry is still working through COVID, and so that's the period that was impacted the most. Now we're kind of in more of an equilibrium where we're much closer to break even.
Can we take a look at that fed cattle and break even prices chart from your Farm Doc article?
We can certainly try.
Technology is wonderful as long as it works, right?
Yep. So here's the returns. First of all, we can take a quick look at that. And this summer's where we saw a lot of that red ink that we were not expecting. And that's where you get the big spikes in net losses, is where something happens that you weren't expecting. You can go back into 2015. We had a large drop in prices that we weren't expecting. The same in the fall of 2019 and in the summer of 2020 was the same way. We were expecting returns to be much closer to break even this summer, and it ended up not being that way because of COVID. If you look at the break evens, the break evens have declined. They decreased quite a bit for cattle finished in the summer, because at the start of COVID, feeder cattle prices went down, and so that's why we saw that drop in break even prices from about March and April all the way through cattle finished. It finished in July and August, and that was because when COVID started, we also had a drop in feeder cattle prices, and so that made the break evens lower. Now we've reached more of an equilibrium, and so the break evens are closer to where we expect the fed cattle prices to be, and so we're much more in a situation where we're expecting in some months, in the next 6 months, we're expecting small losses, and other months we're expecting actually profits. Small profits, and so anything from a loss of $50 depending on the month to a profit of $50, and much more of an equilibrium situation looking out the next few months.
2020 definitely seems to have been a roller coaster for both, for really everybody involved in the ag sector, but specifically and especially on the livestock side of things. As you look into the last quarter of this year, as we round out 2020 and into that first quarter of 2021, what are some things that you're looking at and maybe your outlook for those next couple of months?
Well, the break even. Let's start with where the break evens are at. The break evens are close to about $110 to $115, depending on the month you're looking at. And so we're if you look at some of the people that do the price projections, they're expecting prices to strengthen. They've already strengthened quite a bit here in the last 2-3 weeks. They're expecting prices to continue to strengthen throughout the fourth quarter and into the first and second quarters. And so when I say we're closer to break even, that assumes that the fed cattle price is going to be in that $115 to $116 range in the first quarter of 2021, and in that $118 to $120 range in that second quarter of 2021. If that doesn't materialize, then we're looking at some losses. But based on the feeder cattle prices we've seen the last few months and our expectations of feeder cattle prices the next 2 or 3 months, that's about where we're at in terms of break evens.
Michael, as we wrap up this afternoon, and I appreciate your time so much, what are some best ways for producers to manage some risk as we look at maybe input prices that could be creeping up a little bit, and knowing that there's added volatility and continued volatility on the price side of things?
I think they definitely need to be making sure that they pay close attention to what they're paying for the cattle. What is the cattle that they're placing? What is the potential there for animal performance? Because low animal performance does not translate into profitability typically, and so those are things you can definitely do. And then I think you're going to be fairly stable on the famous last words on the feed cost end, and so I think that's going to be somewhat stable looking ahead. But anything you can do to try to protect yourself in terms of the variations in that fed cattle price is always extremely important, particularly when you're coming out of this COVID-19, where there is still quite a bit of uncertainty, where markets are heading. Anything you can do to protect yourself using futures, for example, would be a very good idea. I would like to talk a little bit about retained ownership, because many times cow-calf producers and also those that background, thinking about retained ownership. Looking ahead, it doesn't look like this is going to be extremely risky time to retain calves in this fall, but you need to make sure you crunch the numbers. And so before you do that, make sure you do yourself a favor and create budgets, both from the backgrounding standpoint, getting those cattle up to 750, 800 pounds. And then if you finish, make sure you crunch the numbers. Make sure that you take a close look at what projected cattle prices are going to be, and don't set yourself up for failure when you place the cattle.
Michael, again, thank you so much for your time this afternoon. We appreciate it greatly.
You are welcome.
I'm Megan Grebner on Brownfield.